This is Kali Persall, editor of Institutional Investing in Infrastructure, and I'm here today with Josh Duitz of Aberdeen to discuss some of the drivers of infrastructure growth. So Josh and I actually did an interview back in 2022 discussing infrastructure as an inflation hedge and some of the tailwinds accelerated by COVID and the war in Ukraine. So it's great to have you back here, Josh. To get started, it would be great if you could just kick us off with a brief introduction of yourself and your role at Aberdeen before we move into the discussion.
Terrific. Thanks for having me back. Really appreciate it. I've been at Aberdeen for about 6 years now, and I manage two infrastructure funds. I manage an open-end infrastructure fund, the Aberdeen Global Infrastructure Fund, AIFRX. I've been managing that for about almost 16 years now. We also manage ASGI, which is a closed-end fund that invests in both public and private infrastructure. So really, it's a unique vehicle because it gives retail investors the opportunity to invest in private infrastructure alongside institutional investors.
Great, thank you for that. So how are infrastructure equities poised to perform amid the ongoing energy transition?
So we think that infrastructure equities are positioned in a potentially advantageous spot during the ongoing energy transition for several reasons. As the world shifts towards more sustainable and renewable energy sources, significant investments are anticipated in the infrastructure required to support this transition. This includes, but it's not limited to, renewable energy facilities such as wind farms, energy storage, and the enhancement of electrical grids to accommodate new forms of energy production and distribution. And the several attributes are that really help this transition, such as the stable returns offered by typically infrastructure investments, what we're looking for in the renewable energy space. There's also regulatory support. There's a lot of growth opportunities within there. We're also seeing a lot of technological advancements, and those continuous improvements in renewable energy technologies are reducing costs and increasing efficiency. So we really think that the infrastructure investments are really poised to benefit from the ongoing energy transition.
So as important as the energy transition is, aside from that, what are some of the other opportunities you're seeing or drivers of infrastructure growth?
There's two major energy themes that are converging right now. We just talked about the energy transition, but we're also seeing electricity demand is accelerating. We've gone through an era of flat demand in the US. Over the last 2 decades, we've seen less than 1% annual growth. In Europe, power demand has cumulatively declined by 10% since 2008. And this demand is increasing because of reshoring, the EV transition, fuel switching to renewables, data center growth. But the question is why? So the core of this increased demand stems from the widespread use of graphic units, or GPUs, in data centers. GPUs are essential for artificial intelligence, machine learning, and high-performance computing. It consumes significantly more power than CPUs, about 3 to 4 times as much power. And this will, we believe, increase power demand by about 12% cumulatively out to 2030. There are certain sectors that are going to significantly benefit from this. Traditional utilities are going to benefit, and we've seen it now. Utilities are dedicating more cash to support this inflection in electricity demand. We saw it in their multi-year CapEx budgets at the end of last year. It increased almost 3x what it normally does. Another sector that's going to benefit from this is the midstream pipelines, which transport natural gas. And we like midstream pipelines, specifically transporting natural gas to key data center locations, such as in North Virginia, California, and Texas. And again, we've mentioned the energy transition, so renewables will certainly be beneficiaries of this. Historically, the past 15 years, renewables have really acted mainly as a substitute for thermal plants. But now, really, we're going to rely on renewables more and more as electricity consumption grows. Just an interesting stat. I don't know how much you use ChatGPT. I use it all the time. It's my new best friend, I call it. A ChatGPT search consumes 10x as much electricity as a typical Google search.
Yeah, that's a interesting stat for sure. It's not something that you think about in everyday life, but everything we do is consuming power and energy. And everything, with AI now picking up, we're definitely going to be seeing those concerns a lot more, I feel like. So you talked a bit in terms of opportunities. You mentioned Europe and the United States, and you went into sectors. Are there any regions that are kind of unexpected where you're seeing opportunities as well?
There are, and that's driven by different dynamics. If we look at the world and the world's population has doubled over the last 50 years. The number of people living in cities or urbanization has tripled over that time period. If we're looking out over the next 30 years, we expect the population to grow another 20%, and the number of people living in cities to grow about by almost 50%. Now, where is that happening? The majority of that population growth is happening in emerging and developed markets. Now, we still like traditional infrastructure markets, but outside of that, we are seeing really opportunities for growth. All those people, they're all going to need power, they're all going to want to use their telephones, they're all going to need subways, they're going to need housing. So it's a great opportunity to invest. If we look at just one area, such as in Africa, the demand for infrastructure due to the rapid urbanization and a young and growing population is increasing demand for what else but cell phones and data. Now, data consumption is expected to grow by 4x out to 2028 in Africa. So we see a great opportunity to invest in wireless cell phone towers in Africa. So there's great opportunities there and across emerging markets. We think emerging markets should be part of the portfolio because of that opportunity set. So generally, we like to do about 15 to 20% of our fund in emerging markets. But again, I think it's important. I know many investors get scared of emerging markets. And I think if you could look at historical performance of our fund, we've significantly outperformed our benchmark and peers, even with that allocation to emerging markets, because these are really essential services they need in emerging markets. And that's specifically what we're looking for in an infrastructure investment with stable, predictable cash flows. So we think EM is a market that has been ignored because of the underperformance, but we see great opportunities due to the population growth and urbanization there.
Yeah, it's interesting you had mentioned emerging markets. I've been having a few discussions lately about the kind of untapped potential there. And you mentioned the underperformance. Just curious, what are some of the reasons why investors are hesitant to branch into emerging markets, just from what you've seen?
I think it's the extra volatility, but also the underperformance. Investors want the regions and areas that have outperformed and expect to continue to outperform. Just because something has outperformed over the past year, 3 years, or 5 years doesn't mean it's going to outperform going forward. So we want to look for opportunities that are a little bit different than everyone's chasing the same stocks, whether it's a FANG or the Fabulous Seven or whatever it may be. We want to see the emerging opportunities, and we think we have found some great opportunities within emerging markets. Again, we want to be smart about our allocations. We're not allocating 100% of the fund to emerging markets. It's not an emerging market fund per se, but we do think there's unique opportunities due to that urbanization, population growth. They're still working on 3G and 4G while we're moving to 5G. So we just see what's happened here as a blueprint, what could happen in emerging markets, especially on the cell tower side.
So what are the main risks or headwinds are you anticipating for infrastructure equities in general?
So when we look at infrastructure, I think there's always risks, but there's two big risks. Number one is government intervention, regulatory changes, nationalization. So we try to always avoid certain countries. We've never invested in Russia, even before they invaded Ukraine. We've never invested in Venezuela. We used to invest in Turkey. We don't invest in Turkey anymore. So we try to avoid certain governments where we think there's extra risk. And you never know when there'll be a regulatory change. And we've seen it even in more developed markets. So we want to be diversified across to try to mitigate those risks. You can't eliminate those risks totally. So that's one area. The second part is interest rate risk. And when I say interest rate risk, I mean real interest rates. when interest rates go higher, if there's inflation, many of the assets we invest in, as we discussed 2 years ago, there's an inflation protection component to those assets. So when interest rates go higher, if there's higher inflation, generally it's offset that higher interest rate cost by your inflation protection component to it. It's when interest rates stay high, when inflation goes down. Now, just looking across the world, and I look at the debt on governments' balance sheets in the United States and Europe and elsewhere, I can't imagine the central banks allow interest rates to stay high if we have low inflation. So that mitigates some of that risk we have. But if they did keep interest rates high when we have low inflation, I think that would be a risk for infrastructure stocks in general.
Yeah, that's good how you tied it back to our discussion before. We're certainly in a different space in 2024 than we were in 2022, but it's interesting to see kind of how that's played out with it being an inflation hedge. Some of those tailwinds we talked about last time were driven by COVID and the war in Ukraine. Now it's 2 years later. Are there any sort of updates or future-facing thoughts you might want to leave off on in 2024, moving into 2025?
So it's interesting because infrastructure is supposed to be a slow-moving category, right? There shouldn't be that many changes. There's some themes, like I've said, I've been invested for 16 years that have been out there. But between the energy transition, which is somewhat new, we talked about data center growth, I should say energy consumption growth due to data centers and artificial intelligence. That's somewhat of a newer theme. And one of the other themes that we've started to touch on a little bit is just in terms of data growth in general and seeing that more need for cell towers. As we transition from 4G to 5G, we need more cell towers and denser cell towers. Another interesting stat, if we have autonomous driving cars is going to use as much data as in 1 hour as an iPhone uses in 3,000 years. So we need more and more infrastructure. So we think there's a great opportunity for infrastructure right now, for infrastructure investments right now. So we're seeing that. And that's changed from, I would say, 2 years ago when we did not have the artificial intelligence boom and the need for more and more electric consumption. And when we talked about pipelines earlier, several years ago, if we talked about pipelines, many investors were worried that due to the energy transition, pipelines were going to become obsolete. Now, being we have this energy consumption trend, we think we need more pipelines, and pipelines are now a vital asset once again in the infrastructure universe. So we think there's a lot of great opportunities here for infrastructure investing.